Chris Wright targeting 2 years for critical and rare earth mineral development. Can he do it? We'll find out next on the Energy News Beat Stand Up.
Secretary Chris Wright has a plan for rare earth and critical minerals, but what's the timeline? This is critical. In an outstanding interview with Larry Kudlow on Fox Business, Secretary Chris Wright covers some of the key points in the upcoming China meetings with President Trump and President Xi. The Energy Secretary Chris Wright discussed the government's efforts to develop and produce rare earth minerals, or what we call critical minerals, because they're not really rare, for various industries. China has strategically dominated the rare earth industry, and here's where we're working to break this. Secretary Scott Bessent just said that China is delaying their enforcement of the rare earth and critical minerals, which is huge win for the Trump administration. But let's go through some of this. And some of the key points, Michael, are we are 2 to 3 years away. Secretary Chris Wright said 24 months. He'd like to get it done in 12, but he says 12. I did not know that we were already processing in California. I didn't think we'd processed anything other than illegal driver licenses and
illegal CDLs.
Oh my goodness. This is a cool story.
No, this really is. And I think this administration led by Chris Wright and Lee Zeldin at the EPA have got a real good handle on this. And I think, no pun intended from the article, this is a critical article on critical minerals relative to the fact that if the goal is to diversify the energy mix, and I think that's a good way to talk about how we're going to have to move forward. I mean, I was just at a conference last week down in Houston. I'm the minerals and non-op firm. And, my job was to sit there and listen to all the speakers. You hear a lot of the same stuff over and over, but that's also an interesting note. When you hear the same thing over and over, you have to take note of that. And every single panelist talked about data centers. And, I know that's an overused term in our business. Oh, we're going to have this huge energy boom from data centers, but it's true. And so the question is, we're either going to have to go through a rapid expansion of our energy infrastructure on the fossil fuel side. We're going to have to build new pipelines. We're going to have to drill new gas wells. And to be honest, a lot of that's not going to happen while these data centers begin to build out. So how are we going to do that? We have to diversify the energy mix, stuff you've been talking about on the the small modular nuclear reactor front, the stuff that Secretary Wright is doing on putting clean coal back into the mix, and diversifying the energy mix is critical. And specifically, if we're going to want to do solar plus storage on some of these data centers to bring down energy costs, because again, that's really the goal of the administration, is to bring down energy costs. I think if you could show them a way to bring down energy costs that they could start doing tomorrow, they would just do it. They wouldn't really care what the source is. And the problem, as you have really dug into on wind, is it doesn't actually lower your energy costs. It just it may look like it's lowering your energy costs because of the tax subsidies and maybe the subsidized electrical dollars that come out of it, but in the long run, it's actually way worse than a lot of your other stuff. So diversifying the energy mix is key. Getting access to these critical minerals are key. And this has been a topic that we've talked about for weeks now, and I'm really glad to see the administration kind of diving into it.
Oh, you bet. We'll have more on that later in the week as more announcements come out as President Trump rolls through. Hey, tomorrow on this same topic, I get to speak with live on our YouTube channel and my X channel with Doomberg. This is pretty cool.
That'll be fun. We love Doomberg.
We love Doomberg on this topic. All right, let's go to the next story, Michael. AI-fueled rally shows weakness as power stocks stumble and investors have questions. We are really, Michael, at Energy Newsbeat at the intersection of finance and energy, and I think this is a wonderful article. Year to date through October 24th, the Morningstar Utilities Index has climbed a respectable 21.86%, outpacing the broader market's 15.8%. Again, the S&P 500 Utilities Sector Index is even stronger. And I've got a list in here of the companies and how their percentage of rate of returns are, their 30-day rate and their year-on-year rate. And Michael, it's kind of important to take a look on here. We've got NRG, we got Constellation, Vistra, Consolidated Edison, XL, Exelon, American Energy. And you start taking a look at this, what is going on with energy companies, and the price of electricity is going through the roof. I mean, we've had a 230% on the East Coast going in because of data centers and AI. And if we're going to see a market split in the data centers coming behind the meters in states that will provide for that with natural gas and all that stuff, so the consumers don't get hit, and where the data centers are in front out there, where the government data centers went in back east, you're going to see 230% increases in the people's power. It's pretty important.
No, I think it's extremely important, and I think what you're seeing is that these power companies are beginning to position themselves to be the real end winner of this AI energy data center boom. And it's smart. I mean, it all comes back to energy. And that's, I think, one of the, again, going back to this administration, not to continue to praise them, but they understand that if we are going to continue to progress down this AI stratosphere, and if AI is, no pun intended, going nuclear, we're going to have to figure out a way to provide low-cost energy to these data centers, or else AI is going to become too expensive for the average person, and it's really just going to be an enterprise product, and all of the gains from AI are going to be wrapped up in the Mag 7. Well, that's not good, because that doesn't necessarily, it does trickle down. We could have a complete argument about the Ronald Reagan trickle down economics and the somewhat flaws in that argument. I tend to overall agree with the concept, but to think that everything just trickles down from the top, it doesn't really work like that, especially when a lot of these gains are mainly being reflected in stock prices, and over 50% of the country is not invested in the stock market. So there's a whole segment that's missing out on this. So I think if focusing on the energy, and I think what you showed here, as I say, 50% of the country isn't invested in the stock market. I'm looking at a chart here that shows the 30-day return profile of all these energy companies, and they're all up. So I think from that standpoint, if you are invested in the markets, you should be looking at these companies, because this is where a lot of those gains are going to go. They're going to go to the top 5 Mag 7 companies, because they're the ones that are going to be controlling the overall AI. But then that next layer deep is definitely going to be the energy companies. I think you've got a great list here, and I completely agree that these premium valuations that companies are getting are critical.
And I'm going to be doing some more deep dives on investors and why the earnings, as we come through Q3 earnings coming out, and start really stripping each of those out individually in different articles. Hey, let's go to the next story here. Greenpeace and the net zero followers are wrong. The world is bifurcating into new trading blocks. This comes on President Trump's China's trip. And I'll tell you, Ed Miliband is the poster child of failed energy policies. And I even noticed that the New York Times, Michael, put out an article that the UK may not survive their horrible energy policies. Woo! Wow. Seeing that article was kind of like, holy smokes. In a pointed op-ed published in the Telegraph, energy analyst, former Shell executive Nick Butler delivers a sobering rebuke to the uncompromising zeal of environmental groups like Greenpeace. Titled, Greenpeace is Wrong. We Can't Have Net Zero at Any Price. The piece praises UK Energy Secretary Ed Miliband's dedication to decarbonization, but warns that a blind pursuit of net zero targets is fueling skyrocketing energy costs and economic pain for ordinary citizens. Well, I went through this article, and as I say, what we are seeing is a bifurcation in the global markets for fixing trade balances. And you are going to see Russia, the US, India, any of the countries that are not following net zero, because the war in Russia and Ukraine is going to end once the UK gets off their high war horse and they fall to the ground and crash, you're going to see the war end because they're the ones keeping this up. So when you see the whole new bifurcation, you're going to see if you're a net zero energy policy, you're going to be industrializing and going to China. All your supply lines are going to go to China. China is going to pivot from the US, and in a few years, you will probably see the US not the biggest customer for China if this all plays out. Then you will see all of the other countries trading with the US and more trade going with South America. I think we're off on the races here.
No, I completely agree here. I mean, the fact that people are still in on Greenpeace shocks me, considering the guy who founded Greenpeace basically said Greenpeace is a scam. And it's taken hold in these countries, like you said, the UK, the EU has continued to put themselves. I love this title of one of the sections here, Europe's green straitjacket from vision to victimhood. And I think it's absolutely hilarious. And then kind of, as you say, tying that in, that's sort of making its way to California, which is hilarious considering that, if anybody should be for low-cost energy, it should be California, aka the Golden State, which is our favorite state, by the way, and our favorite governor, Gavin Newsom, is.
We love New York, New Jersey, Delaware, and all the Democrat-run states with high taxes because we get so many inquiries on investing in oil and gas and tax cuts, Michael. I love those states.
Yep, jack your taxes up, California. We need it.
Yeah. And we'll show you how to not pay your fair share.
Absolutely. All right, let's talk about ANWR.
Let's go to the next one. Now that Alaska and ANWR is open for lease sales, who will develop? Michael, the world needs trillions of dollars of investment just to meet normal decline curves. That being said, we are now watching an area in a move that reignites one of the most contiguous debates in American energy policy. The Trump administration flung open the doors to oil and gas leasing in the Arctic National Wildlife Refuge, ANWR, and the U.S. Interior Secretary Doug Burgum announced the completion of a plan to make the refuge 1.5 acre million coastal plain available for exploration and development. Who's going to step up and pony up in this day and age right now at $50 oil? Not many. ConocoPhillips is in there with deep north slope roots and recent wins like the $8 billion Willow project might ANWR. I doubt they're going to be coughing up because you look at their financial statements, they don't have it in their budget. That's what we're going to be watching. So, Michael, the key point out of this is watch who the leases are. I'm going to be getting a hold of Chris over at EnergyNet and really kind of taking a look at how those leases are being sold, who's buying them, who's paying them out, and who do we invest in as we evaluate this. Alaskans want oil and gas drilled. They love it. And that's jobs out the wazoo up there.
Yeah, I think in this article, I think brings up two specific companies that would be interested in possibly doing something. Obviously, the first one is ConocoPhillips, kind of tacking on to their $8 billion Willow project that actually got approved under the Biden administration. So remember this. This is not just a Republican talking point. This was approved under the Biden administration. There are some synergies there. I think, you also mentioned this article, Hillcorp, which had been very, very active in the North Slope for many years, but did famously in 2012 basically exit. Now, if there are some tax credits and infrastructure tie-ins and infrastructure plays available to possibly bring them back, they really could. I don't believe you're going to see like big companies like Exxon and BP or Chevron decide to take a dive into here. I just think there's too many other strategic initiatives, specifically with Exxon and Chevron now controlling Guyana. BP has really shown they've really shown no initiatives to want to be able to do this. I don't think BPX is really interested in doing something similar to this. So I think it's going to be interesting to see who comes in and takes these leases. It is a small oil company who decides maybe they want to get into the gold rush here. I think the hard part is going to be the capital needed to spend to do this. And I love one of your titles here, Sticker Shock, the capital expenditures of the frozen north. It's going to continue to be expensive. I mean, you have to talk about the roads, the infrastructure that you have to build, the heated pipelines, a bunch of spill-proof tech that needs to continue to be in there. And that is way above and beyond what is kind of normal conventional U.S. shale costs. Even at 7 billion barrels of estimated recoverable reserves, that could cost between 10 and 20 billion dollars for example, for a single large scale project. And, that's if you trust Yale. And I think Yale is probably coming in a little bit low relative to that. I think operating expenses are also fairly intense. And to give you guys an idea, global upstream CapEx was 85 billion in 2020. And you're talking about 20 billion just in one project. I think it's going to be very difficult, but I think I agree with you. Following who's going to get in on this is going to be key to lowering energy costs.
Exactly. And I'm going to read this one paragraph here. Drill, baby, drill sounds good until you have to pay the bills. And $60 oil is the old $40 oil due to inflation by everything else that's gone on. As Stu Turley and Michael Tanner have talked about on the Energy Newsbeat podcast, that's us, and their deal evaluations, it's about the returns to investors and being fiscally responsible. Like a puppy with a rolled up newspaper, if you beat the puppy too much, you lose the puppy's affection. And I'm serious. The oil companies have been beat with a newspaper, a big newspaper, and they are not being fiscally irresponsible anymore. And it's almost a detriment. No. Let's go to my last story here. New sanctions will not stop the war machine. President Trump, I do love President Trump. I think he's our greatest president we've ever had. The amount of things he has overcome, but his listening to the warmongers is dead wrong. And as the Ukraine conflict winds into its fourth year, Western powers are again turning to the familiar playbook of economic sanctions this week. The United States slapped sweeping restrictions on Russia's two largest oil producers, Rosenfit and Lukoil, while the European Union rolled out its 19th sanctioning package over 100 shadow fleet tankers in banning Russian liquefied natural gas LNG imports by the 2026. By 2027, they're supposed to be all out except for the landlocked countries of Poland, I believe, and not Poland, but Hungary and a couple others over there. But Michael, the dark fleet is about 1,680 different tankers that are out there. 750 are owned by Russia. Iraq, Iran, Venezuela, they all are in this mix in there. And hitting that is like trying to hit a whack-a-mole. It is a very well orchestrated movement, and sanctions don't work as intended. This is just a huge mistake. Now, this brings up another article that I did last week. What is the real reason for Venezuela? Because we don't have sanctions going on really there. They've got a huge reserve, but everybody thinks that the war going on in Venezuela is simply because of the narco-terrorists. No, it's because the Monroe Doctrine has not been enforced for the last 30, 40 years, and this is about China's encroachment into South America. Buckle up. We got some more things coming around the corner on that one.
Yeah, I mean, this article just leads me more to a question of like, why do this? Like, I think the data is really clear that these sanctions haven't worked. And selfishly from an oil and gas standpoint, like $55 oil was not pretty. I mean, it's nice to see $61 oil it's nice to see oil above 60. So these sanctions have helped it, but what do you think the rationale is? Who's in his ear? Like this, it just doesn't make any sense.
No, you've got the folks that have been in his ear are pro-war. And it is the entire pro-war. The EU is on a current track to fail because the Bank of London and the EU need a war to continue their financing. What President Trump needs to understand is the war, and he's doing it. He's just signed another peace deal, I believe, between Malaysia and another one that it's going to be on the news here pretty soon. He's working peace. We will see an end to the Russian-Ukraine war very soon, and I think that we are closer to a solution without the EU's input.
Yeah, Very, very interesting. But I know I think this is a super interesting article just because this plays into I think what we're going to talk about on the other side here when it comes to what happened to oil prices. But first, let's pay the bills. As always, guys, the news and analysis you just heard is brought to you by world's greatest website, www.energynewsbeat.com. Stu and the team do a tremendous job making sure that website stays up to speed, everything you need to know to be at the tip of the spear when it comes to the energy and the oil and gas business. Go ahead and hit the links in the description below for all links to the timestamps, links to the articles, and specifically subscribe to the show on YouTube, subscribe to the show on Apple iTunes, give us a follow there, subscribe to our show on Spotify, please leave comments there, and subscribe to our Substack, theenergynewsbeat.substack.com. That's probably the best place to support the show. Stu does a great job of releasing, 2 to 3 articles a week that really encompass the big themes that are going on. We also drop all of our podcasts there, which give a little bit of a breakdown. We just had a great podcast. So I highly recommend everybody subscribe to our Substack, theenergynewsbeat.substack.com. We'd also like to thank friends of the show, Reese Energy Consulting, for supporting the show, guys. Reese Energy Consulting is the foremost midstream expert, guys. If you at all are dealing with issues in the midstream space, whether you're an upstream company and need help with first purchaser's contract or renegotiating your gas contracts or figuring out where you're going to tie in your next pad because you've got multiple different options and you're trying to break it all down, Reese Energy Consulting can help. If you're in the midstream space, I need an extra pair of hands, need some permitting or regulation help, or need some red team analysis on a final investment decision, guys, they have the team that can help you. Check out reeseenergyconsulting.com. They have clients everywhere and all throughout the country, from 2 people in a garage all the way up to the largestly publicly traded companies in the world. So if you're wondering, are you a good fit for them? The answer is yes. reeseenergyconsulting.com. And finally, guys, invest in oil.energynewsbeat.com. We are coming up on the end of the year, and I promise you guys, you do not want to be paying money to Uncle Sam. You want to keep as much money in your pocket. You want to diversify your portfolio a little bit, and you want to get some dividends. You can do that by investing in oil and gas. Check out investinoil.energynewsbeat.com. Fill out our portfolio survey and our tax calculator. And guess what, you guys are going to get a nice ebook that tells you here's what you should look for when you invest in oil and gas, and also figure out what your tax burden is and figure out how much you might save relative to your tax burden if you did invest in oil and gas, guys. We practice what we preach here, guys. We do this stuff ourselves. Invest in oil.energynewsbeat.com. Don't give your money to Uncle Sam. Figure out and find out if oil and gas investing is for you. Depending on if you qualify, we will, again, send you all that information, and we may or may not point you in the right direction. Again, invest in oil.energynewsbeat.com. I mean, in a real complete reversal, Stu, from where we've sort of seen oil pricing end up. We saw on Wednesday of last week, those, as we just talked about, those new sanctions that came out from the Trump administration on Russia's 2 largest oil companies. And now all of a sudden we're ending up in this interesting scenario where we've saw the first week-over-week rise in oil prices over the last couple weeks. Oil settled at $61.50. Is set to open here in a bit. As we record this on Sunday afternoon, it's somewhere around that range. I wouldn't be surprised to see if things go slightly higher from this. Natural gas settled at $3.33 or $3.30 and looks to open probably slightly higher relative to where things are at. We also did see the S&P 500 and NASDAQ kind of make a complete comeback from those tariffs to be pushing all-time highs from a portfolio standpoint. I think it's really interesting to see what happens. Treasury Secretary Scott Bessent said on Wednesday, here's his quote: "Given President Putin's refusal to end this senseless war, Treasury is sanctioning Russia's 2 largest oil companies that fund the Kremlin war machine." Scott, that's again Treasury Secretary Scott Soros Bessent. Oh, did I slip that in there? I'm sorry. We also did see U.S. crude oil, gasoline, and distillate inventories fell last week. That was according to the EIA. Crude stocks fell about 961,000 barrels to about 422.8 million barrels, and that was really compared with an analyst expectation of about a 1.2 million barrel rise. We love our friend Phil Flynn over there at Price Futures Group. We've got a total oil demand above 20 million BPA. Very impressive for shoulder season. It shows the demand side of the equation of oil is robust, which I think is what people are working out. We also did see President Trump at the beginning of the week said he expected to work out a fair trade deal with Chinese President Xi Jinping, who is due to meet this week in South Korea. We also did see that some of that summit between Trump and Putin has been put on hold, as there's been some upscaling of this war in Ukraine, which is, I mean, it's getting scary out there. I'm going to start stocking up on my MREs. We did see rig counts jump by 2, frac count spread jumped by 3. So, obviously, that's not a direct correlation with what we saw happen on Wednesday. But I think people are oddly drilling maybe more than I think the street would like them to, relative to, I think, where we're at. And I think this is the interesting part, Stu. As earnings seasons begin to roll out, we're going to start reading some tea leaves from that. A company that I think gets a lot of coverage, whether it's good or bad, I'll let you, the viewer, decide, is a local DFW-based company, Matador Resources. And, it doesn't matter where you fall on this train in terms of, okay, do we continue to drill through the cycle, or do we wait and save our locations for higher oil price environments? And I think what you see from companies and what you see from I think the street and the people that cover it is, hey, we need to make sure that we don't drill our best inventory at the lowest prices and lose out on an increment of dollars when we might be able to save that inventory and drill through and save it and drill through better prices in the future. Now, the flip side of that is, okay, well, what are we supposed to do? Because our best locations are the only locations that make money at these prices. So what do? We don't do anything. We go drill our worst locations at the worst pricing. I mean, that doesn't necessarily work. I think there's this two competing things. But if you want to know how the street values drilling and promoting production growth in this price environment, Matador Resources earnings was the perfect example. They announced on Thursday, their third quarter financials, and they were, quote, pleased to report record production of 209,000 barrels of oil, of BOE per day for that quarter, which exceeded their midpoint guidance of about 199,700 BOE per day by about 5%, which is a 22% year-over-year gain in production from the third quarter of 2024. Oil production made up about 119,556 barrels for the third quarter, which exceeded the midpoint guidance by 2% and was a 19% increase year over year. They also had record natural gas production. They spent about, I'm trying to see what their capital expenditures were. Their full year 2025 D&C costs will be at $1.18 to $1.37 billion. They're raising that from their original guidance, mainly due to the drilling and completion of an additional 20 net operated locations, which what they're saying is made possible by operational efficiencies and historical opportunities to experience lower service pricings during the second half of the production year. They tout their continued high capital efficient program with flexible to adjust production on CapEx. But as you know, Matador, they love touting about how much their first 5 lines in their operational update was how they're increasing production. And so you would think with such great news, the street would love it. Well, no, their stock dropped 10% on the day they announced this. I'm not kidding you. Their stock dropped 10%.
Wow.
After they announced 22% year-over-year production growth. So, Stu, I ask you, the wise one on this podcast, does that mean the street values production increase right now?
Nope.
So what does it value? Being
that was a technical
smart,
term.
Not efficient. Efficient and smart are two different words. I can be efficient at really doing the wrong thing, but I'm efficient at it. Oh, exactly. I drove 500 miles in the wrong direction, but I stayed on the highway the whole time, and it was really efficient driving. Well,
right.
You're 500 miles away from where you need to go.
Or I got a CDL and I can't read until they pull me over, and then they hand me a kindergarten book. So, I stayed on it for 10 years. They actually had a illegal that was on a truck driver for 10 years and could not read.
And this goes along the point of Matador having 5 different CFOs over 5 years. It's
how many
our
IR
phrase
guys?
"good management, good numbers." Well, I mean, we don't even know who management is outside of their we know who their CEO is. He's the longtime a longtime chairman and CEO. So we kind of probably have an idea of why there's 5 CFOs. I can probably, it doesn't take a genius to figure that out. I'll let you, the brilliant audience, kind of put 2 and 2 together. So, I wanted to just call out this earnings because this is how the street is valuing production growth at this time. And it's going to be very interesting to see how companies navigate this lower oil price. I mean, obviously you still have to drill, but you have to be smart about it. You have to not only just be efficient, but you have to be smart about it. So I think it's really fascinating. But yeah, Matador, record oil production, stock drops 10%. Who would have thought? Favorite time of the week, Stu, what got you worked up this week? What are you worried about?
Oh, I'm not worried about it. I think the world is going to heal. I think we are on the right track. I see that from contacts that I talk to around the world, people are waking up, and I see some great things happening around the corner.
Good. Well, that's always great to see. We've got some great podcasts coming up. The day you listen to this, we will be recording a podcast with Doomberg. We always love Doomberg, so we'll make sure to get the clips out, have that turned around, hopefully by Thursday. Or it's live, right? It's live.
It is live. We'll have it out on Substack tomorrow.
Great. It'll be out on Substack on Tuesday, which is great, guys. But as always, we appreciate you starting your week with an Energy News Beat. Subscribe to our Substack. Subscribe to our YouTube. Thanks, everybody, for following us. For Stuart Turley, I'm Michael Tanner. We'll see you next time, guys.